President Trump is not wrong about interest rates and the strong dollar, but does the Federal Reserve have any ammunition to do anything about it? Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today, we're going to be talking about monetary policy, the U.S. economy, President Trump, and the Federal Reserve. Right now, we're experiencing a situation where the 10-year, 2-year Treasury spread has been signaling potential recession signals, whereby the 10-year, 2-year Treasury spread has, during intraday trading periods, dipped below zero. The most recent was on August 22nd, and it can happen again. And it's pretty close there as of this broadcast at 0.002, and that's it doesn't get much lower than that without going negative. Typically, over long periods of time, 10-year, 2-year inversions have signaled or preceded recessions on average by about 16 months. You can see similar phenomenon with the 10-year, 3-month, and also with the federal funds rate versus the 10-year Treasury. When that inverts, the Federal Reserve will tend to go into a higher interest rate at the low rate than the 10-year Treasury typically goes. So all these things tend to invert if you look at recessions in modern history. Now, President Trump is responding to what he says are relatively higher interest rates in the U.S., that we are giving off higher interest rates at times when Germany and Japan have lower interest rates. So if you look at the German 10-year bond, it's gone negative in recent years. It dipped below slightly in 2016, and now it's negative again. And then Japan has had the same phenomenon in 2016. It went negative, and then now it's going negative as well. And so President Trump on Twitter was commenting on this on August 22nd, saying, quote, German sells 30-year bonds offering negative yields. Germany competes with the USA. Our Federal Reserve does not allow us to do what we must do. They put us at a disadvantage against our competition. Strong dollar, no inflation. They move like quicksand. Fight or go home. So President Trump is criticizing what he says is a strong dollar and higher interest rates. And it's true. The U.S. 10-year treasuries, they're trading at about a 1.5% now. 1.6%, and they are certainly higher than overseas competitors like Germany, like Japan, who have negative interest rates. And if you look at the federal funds rate, the Federal Reserve has been keeping the federal funds rate higher than the 10-year Treasury. We just pointed to that as we have an inversion here. And it's been inverted since May, and President Trump is saying, why are you letting this invert? If you see the 10-year Treasury dropping, you need to drop the federal funds rate. So he's not wrong in terms of what the dollar is strong. If you look at versus other currencies, here it is, the U.S. dollar to the Chinese yuan. China's been on a devaluation path since early 2014, when it was at almost $6, 6 yuan per dollar. Now it's $7 yuan per dollar. Other countries, if you look at the euro, it used to be 0.67 euro per dollar. Now it's close to 0.9 euro per dollar. So in Europe, the European Central Bank, they've been on a devaluation scale. If you look at Mexico, they've been on a devaluation kick too. So they were at about 11 pesos per dollar. Now it's almost 20 pesos per dollar. Very steep devaluation there in Mexico. And what does this do? This boosts exports to the devaluing country. We've looked at this in the past, and it certainly leads to a stronger dollar relative to these currencies. So Trump is not wrong. But even if the Federal Reserve now was to aggressively start cutting rates right now, if you look at the federal funds rate over time, typically the Fed will start to cut the federal funds rate right before a recession. And so that's where we are right now. It got up to about 2.5% in the current hiking. That occurred starting in 2015. They did the first rate hike prior to the election, but then they held off until after the election to go ahead with the aggressive rate hiking. Such that now it through 2017, 2018, 2019, finally, now they're starting to cut again. The most recent cut came on July 31st. So moving forward here, so if the Fed were to aggressively start cutting rates now, would it make the dollar stronger? We were at what I point to is the fact that during the Obama administration, we were at near 0% rates for most of his term in office, 8 years. But it didn't yield really robust economic growth. The growth was still tepid while we lost global market share to China. And that was certainly true throughout the Obama administration. The Chinese were able to increase their global manufacturing market share. All the while, since the 2000s, when China entered the WTO, we were losing global manufacturing market share. We didn't have robust growth. And we were losing labor participation. And you can directly attribute that to China's devalued yuan policy that began in the mid-90s. They kept it there all the way until about the financial crisis was starting, and then they allowed it to start to revalue, and even as they were increasing global manufacturing market share. And that was, and it basically it was still artificially low through the end of that cycle, and now they're devaluing again as President Trump attempts to levy tariffs against China for its distortionary monetary policies, intellectual property theft, forced technology transfer. They've been trying to get a trade deal, but now China's going ahead with a $75 billion tariff. Trump is now ordering U.S. companies to stop doing business with China. It could be very risky right now to do so. And Trump's been trying to reform global supply chains to move investment out of China elsewhere in lieu of a trade deal. He'd rather get a trade deal, I think. I think we'd all rather see a trade deal. But right now we're having a conflict on trade and on economic policy and on monetary policy. And President Trump is determined to use his presidency, his moment in the sun, to try to do something about it. Whether he succeeds or not, that's what his position is, and I think everyone clearly understands it. Now, if you look at where Germany and Japan are vis-a-vis negative interest rates, I don't think these are actually positive economic indicators. So if, say, the Fed were to go down to zero again or even go negative, we've already noted that during the Obama administration it didn't do much to boost growth. But so if you were to go negative, just as high interest rate environments tend to signal inflation, a low interest rate environment or a negative interest rate environment, I think, would signal deflation with slow or no growth. We've seen that out of Japan and Europe, where they have really low interest rates and low inflation or no inflation or even deflation, and it doesn't lead to growth. So if rates were to go negative, though, Trump is right, that means the dollar is too strong relative to other currencies. That's what the low interest rate or a negative rate would be signaling. Now, whether the Fed could weaken the dollar sufficiently with interest rates and open market operations to cure overseas competitive devaluations, whether it's from Mexico, Europe, or China, is a really great question, but I don't think so. I think the Fed's out of ammunition here. I think that when it comes to the dollar being too strong, they're out of bullets. This is something we have to work out with diplomacy, with our trading partners, and via some international monetary accord, perhaps as a part of a trade agreement such as the one that was currently being negotiated with Beijing. I've previously suggested that we could bar China from buying treasuries and basically to not let them stockpile them as a potential penalty for their currency manipulator designation by the U.S. Treasury. On the other hand, such a drastic move carries a lot of risks in terms of disrupting financial markets and would carry further repercussions in terms of U.S.-Chinese relations. But here's the conundrum. How do you weaken the dollar when it's the world's reserve currency and everyone else piles it up like it was gold? And what's more, everyone has an incentive to do so because it makes their exports cheaper and makes their own currencies weaker, makes the dollar stronger so they can ship more goods here, boosts their growth and hurts our growth. So what do we do about that? in this sense, I understand and appreciate the president's frustration with the Fed. When it comes to economic conditions, arguably the Fed waited too long to begin hiking rates. They didn't start until December of 2015, and then they didn't go full throttle on the rate hiking until after the election. So you could ask the question, were they trying to time a recession to occur around the time of the U.S. election in 2020? Because they could have started hiking back in 2014 or 2015. I think you might have already seen the recession. You certainly would have already seen the inversion on the federal funds rate. I think that would have occurred much sooner. It could have been on the verge of occurring back in 2016 if they had kept on hiking back then, for example. But that might have hurt Hillary Clinton's chances of election and hurt Democrats in the election. So was it politically timed till after the election? I think that's a good question. It's a fair question because we don't want the central bank to be engaged in distortionary policies that are intended to affect politics or to just do things that would affect politics. Turns out Trump was going to win the election anyway, so they might as well have started hiking the rates way back in 2014 or 2015. Either way, the rate now, the effective federal funds rate is only at 2.4%. And it doesn't have much room to go down now. And I think that's because we didn't hike enough, and you have really low interest rates as it is. So even when the next downturn occurs, you're going to be pressed up against 0% interest rates very, very quickly, I think. And so then there will be pressure for the Fed to go negative. And so we're in a zero bound territory right now. And we could be about to test the negative interest rates in the next recession when it does come, and all of the perverse incentives that might create as borrowers, including governments, are paid interest to borrow. And I think that we've talked about this before, about this could be the end of capitalism if you have the perverse incentives that are brought up on by negative interest rates. And I think we should be concerned about that. We should be trying to have positive rates of return on investment. We want to have growth. We don't want to see deflation. We know what that looks like. From the Great Depression, when you have full rampant deflation that was brought on by exchange rate policies overseas when the Brits were ending the gold standard. We've looked at papers on this in the past from Eichengreen and Sachs, and they were writing about exchange rates and how that's important to monetary policy. And I think that's the right attitude we should be looking at right now. But nobody's talking about exchange rates except for President Trump. And so when they looked at this back in the 80s, they wrote a paper and they wrote, we argued that depreciation clearly beneficial to the initiating countries. They were able to boost exports. They could boost employment. We established that there is no theoretical presumption that depreciation in the 30s was a beggar thy neighbor policy, but the evidence suggests that they did have beggar thy neighbor effects. But they think the devaluations were actually beneficial to the groups as a whole once everyone engaged in them. And the U.S. Waited a couple of years after the Brits had ended their ties to the intra-war gold standard. We didn't come off until 1933, and only then did the unemployment rate start coming down. But it's arguable that we waited too long. Now, in all cases of unilateral devaluation, currency depreciation increases output and employment in the devaluing country. And we noted that it did have beggar thy neighbor effects on trading partners. And so I think that's what we've been experiencing here in the United States, where as China devalued, we lost global manufacturing market share, and they gained global manufacturing market share. And you can see similar patterns with other trading partners. We've looked at the euro, we've looked at the peso, and we've certainly looked at the yuan. Everyone's engaging in these policies, but nobody's talking about exchange rates as an important tool in monetary policy. Federal Reserve Chairman Jerome Powell just gave a speech today, and he talks about 3 eras of monetary policy, 1950 to 1982, 1983 to 2009, 2010, and after. He does mention the trade conflict right now with China, but almost in passing. He doesn't mention the exchange rates, and I think that they're very incredibly important to monetary policy. Now, they say they're having this Fed listens tour. Well, Fed, listen up. You're having distortionary exchange rate policies by our trading partners. It's having deflationary pressures that you acknowledge when you're giving speeches. So we need to have some tool to counteract that. That's what President Trump is talking about here. Now, he realizes that the tools that we have in the Federal Reserve's toolbox are interest rates and open market operations. They can buy and sell bonds. They can do easing. But we also saw during the Obama administration with near zero rates and quantitative easing, trillions of dollars, it didn't have much of an impact in terms of boosting growth here. Now, unemployment rate was dropping, that's true, but we weren't able to get out from underneath, I think, these distortionary policies and China's unnatural peg to the dollar. Granted, maybe there's not much you can do about it. Because it has to come to an international monetary accord. But we should be looking at that. I think that there certain tools would be useful to disincentivize countries from engaging in distortionary, devaluing policies that impact upon our growth. Now, in theory, the Fed could cure its own interest rate inversion right now by dropping its rate towards zero, but it's worth noting that the Fed tends to ease as we get closer to recession. So if they were to start dropping the rate now, it could be a signal to markets that the recession is at hand. So president should be careful what he wishes for. On the other hand, could the Fed, by cutting the rate right now, end its own inversion and help avert a recession right now? Could we forestall it? That's a good question. And I can see why the president might be concerned. There has been some talk about how interest rate inversions are the cause of recessions and not merely predicting. I don't really buy into it, though. Looking at the history, that when the Fed inverts prior to recessions, its own rate, the 10-year 3-month tends to invert, and the 10-year 2-year tends to invert prior to recessions. Those seem to be predictive, not the cause. It's not like we're talking ourselves into recessions, unless every recession in modern history has been kind of some sort of psychological phenomenon. I don't think that's true. Or at least I don't think there's data to support that. I'd like to see more data. Either way, it is clear we are nearing the end of the business cycle. Right now, the economy is strong, coming off its strongest growth since 2005. And we have a record low, 3.7% unemployment rate. That's like near 50-year lows. You have to go back to 1969 to see rates that low. Once the 10-year, 2-year fully inverts, you might expect a recession about 16 months later, but that might not be until after the election. So it may not even have political import towards how the 2020 is going to play out, because you can predict a recession right now, but if the growth rate comes in good, the unemployment rate stays low, everyone's going to shrug and say, what recession? But it could come sooner, though, and I'll leave you with the close here. A good question might be whether the central bank timed its own rate hiking after the 2016 election so that a recession would occur just as voters were headed to the polls in November 2020. Were they out to get Trump? We'll find out soon. Stay tuned. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.